morning. Welcome to the library. So happy to see you guys here on this hot June evening. My name is Lauren Gramley. I'm the business specialist here at the Champaign Public Library. Here at the library, we have all sorts of great resources for starting and growing your business, including awesome, amazing, informative workshops with local experts. We have one-on-one consultations with me, the business specialist. We also have a number of really great databases here that you can use to do some research if you're interested in trying to either start or grow your business. But I'm really happy to have you guys here tonight for banking and financing for your small business. I'm very pleased. I'm going to go ahead and introduce our two presenters this evening. So tonight we have Bryce Hutchcraft. Bryce serves as Market President of First State Bank's Champaign Market. He has over 23 years of experience in the areas of commercial and business banking and specializes in providing innovative and customized business solutions. Bryce is active in the community and has served on the board of the Illinois Housing Development Authority since 2022. Bryce holds a Bachelor of Science degree in Finance from the University of Illinois Urbana-Champaign. And tonight we also are pleased to welcome Tristan Brown. Tristan Brown has worked with Justine Peterson since 2021. And has since assisted over 200 small businesses within the central Illinois region, providing access to over $3 million in capital through Justine Peterson's microloan program. Justine Peterson is Illinois' largest microlender, with mission lending being the main concept. The Justine Peterson program brings capital to those who traditionally and historically have been able to access the resources they needed to succeed. And I'm very pleased to have both of these gentlemen here this evening. And I would like to welcome up first to the podium to Bryce Hutchcraft.
Thank you. I think maybe I will use this handheld mic. Can you hear me in the back?
Yes.
Okay. That's me. You're here about who I am. So I'm going to talk to you tonight about the conventional side of financing. So I'm from a conventional bank. Tristan's from Justine Peterson. A lot of the stuff you'll hear from him is a lot more creative, some gap financing options, things like that. So what I'm going to talk to you about tonight is more like what to expect if you're going to one of the brick and mortar banks that are here in town. So what I want to lead with is let you know, remember that bankers are just real people too. We're people that are walking amongst you in the community. I know that historically, banking has been somewhat unapproachable to a lot of people. It can be intimidating. I'm here to tell you tonight, hopefully in this quick presentation, that it's not rocket science what the banker on the other side of the desk is doing. Hopefully you'll walk away kind of understanding how the bank is going to look at your application when you come in to apply for a loan. So hopefully that'll take away some of the fear you might have in going and talking to the banker. And just remember, we're really not that scary. So what I'm going to talk to you about, I'm going to go through the first few parts of this a little faster than I typically do. I do this presentation a couple times a year at the University of Illinois, so there's a different audience there. So talk about banking services, kind of an overview. We'll go through that really quick. I'll talk about the loan process and the 5 C's of credit, then tips for establishing a valuable banking relationship, and then we actually are going to keep question and answers till the very end. So if you have any specific questions for me, maybe hold until the end after Tristan has done his presentation. So banking services, anybody who has a banking account, a credit union account, you kind of already know this. This is kind of like the 4 areas of the bank. Commercial lending, which is what we're talking about, commercial/business lending. There's also mortgage lending for people who are looking to buy a home to live in. Personal and business deposit services, so that's where you'll open up your personal or business checking account, savings account, money markets, certificates of deposit, and things like that. And then we also, a lot of banks offer trust and wealth management. So once you've made your millions and you want to invest them with somebody, you can come and talk to the bank about doing that. Again, you probably already know this. Banks have checking, savings, money markets, CDs, cash management services, which is something you eventually will want to use in your business, things to help you move cash effectively and make sure you're putting your money to the best use. Again, trust and wealth management, that's when you've made the millions and you want to invest it. Retail and personal lending, obviously we're here to talk about small business and commercial financing, but remember the same bank that maybe you do have a mortgage with or you do have a car loan with might be the great place to first start because you already have a relationship with them and they kind of already know who you are. So here's what we're talking about today. The commercial side of the bank. So we do all kinds of financing on the commercial and business side. One, business startups. Banks, conventional banks do loans to startup businesses. Lots of times, we'll use SBA as a vehicle to help do that. Some of the community programs that exist through here locally at the CDC, Justine Peterson, and places like that. We finance fixed assets, which are things like equipment, furniture and fixtures, vehicles, maybe if you have a delivery vehicle or something like that. And lots of banks also will do leasing. The bank that I work for actually does not, but a lot do. So if you ever wanted to maybe lease a vehicle for your business, a bank might be able to help you do that. Obviously, we do real estate, so every offices, warehouses, retail, apartments, investment properties that you're gonna buy the building and rent it out to somebody else for income. Banks do that. And we also do lines of credit, so operating and working capital lines of credit to kind of bridge the gap of your working capital needs and your receivable cycle. I'm going to skip through this one. If anybody is in here is looking to do residential investment real estate, this slide's for you. We can talk more about it later. So here's the loan process. So the first thing you're going to want to do is make an appointment to meet with a banker. I might recommend you maybe not just walk into the bank and say, hey, I want to talk to someone about a business loan. Maybe do a little research, ask a friend, a family, someone else that you trust in business, who they like to work with in the banking community. Get that person's name and contact information and call to make an appointment. There's this. I'm showing you behind the scenes of banking. So there's a rule in banking, the commercial side, that someone who walks in off the street to talk to you about a business or commercial loan is either a credit risk or a sociopath. We don't want to be either of those things. It doesn't mean you are, but it's just most of the time when someone walks in off the street for a business loan, it's probably not been a fully thought out process, so it usually doesn't really go anywhere too fast. So call and make an appointment. You'll be steps ahead of the game. So the first thing you're gonna do after you've met with the banker and you've kind of talked through what you're looking to do is the banker's gonna have you submit an application or a financial package. Lots of banks on the commercial and small business side don't actually have an application that you fill out. Like if you think about if you're getting a car loan or a home loan where you might sit down with a paper document and fill out a bunch of information or go online and submit an application that way. Most banks, they're just gonna collect a lot of financial information from you. That would be tax returns for your personal tax returns for usually the last 2 to 3 years. If it's a business startup, they're going to ask for your financial projections, which could be part of your business plan, along with a lot of other information in the business plan. And your personal financial statement, which the banker will almost always throw an acronym at you of PFS. That's your personal financial statement. That's a template they can provide you. You can Google it. The SBA has a really good one on the internet. They're almost all the same. They capture the same information. It's your personal balance sheet. So it's all your assets, what do you own, and all your liabilities, what do you owe, and then some more detail about all of those things. Once you submit the full package to the banker for their underwriting, they're going to submit it usually to an underwriter who's going to do a lot of the number crunching and usually come back with some questions, whether it be an existing business where, hey, what happened here a couple years ago and these expenses went to here, or your income went down here, what happened, to get more detail on that, or just some more questions about maybe some things you have in your projections or what you're looking to do. And once they've had their answers, they're going to come back to you with a decision in terms. Hopefully that means you got approved and they're going to say, here's how we foresee proposing your financing for your business. From that point on, if you say, yeah, that sounds like something I can accept and I like the terms, there's usually a due diligence period based upon what you're giving the bank as collateral. So if there's real estate involved, there's going to be appraisals that have to be ordered and title searches and things like that. Sometimes if it's a startup, the bank may require a feasibility study. Usually not so much on the small business side. That's usually for a larger loan request that a bank would want you to have a feasibility study, which would basically say, this is a new business idea, and you hire a third-party company to come out and run a bunch of data and say, yeah, this business sounds like it's something that could happen in this market, or probably not. Most of the time when you pay for a feasibility study, I find the feasibility study company finds a way to say that your business is feasible. And then after that, after all that's done, you're going to close. with the bank. You're going to sign all the paperwork, and they're going to give you your money to do what you applied for the loan to do. So this is the magic curtain. This is the 5 C's of credit. So regardless of what kind of loan you ever get, if you've ever gotten a car loan, if you've ever had a home loan, if you've ever had even a credit card, this is the basis for how the bank is going to underwrite. When you hear them talking about underwriting, this really is what they're looking at, the 5 C's. So we're going to go into each one here a little more detail. The first one is capacity. If you asked me to name off the top of my head the 5 C's of credit, I probably would not say capacity. I probably would say cash flow, because the two big things that banks look for when you apply for your loan are cash flow. How are you going to repay the loan? The bank wants to make sure, first and foremost, that your plan shows enough profitability to repay whatever loan you're applying for. So capacity / cash flow. By the way, that's me with Colombian pesos. They're not US dollars. I think that's about $100 worth of Colombian pesos. So it's your ability to repay the loan. It's also looking at what's the likelihood that the income that you're currently having today will continue or grow based upon your projections and things like that. Again, your financial projections that are in your business plan come into play here. I know that business plans can seem daunting and almost seems like it's just, I'm going to use the word haze, but it's almost like you're getting put through this just so you can apply for the loan. Just know that the bank really, really, really does look at your business plan, especially the projections. There are some really good spreadsheets and templates out there. I'm sure Justine Peterson has some recommendations for you. I know SBDC has some really good models for you that kind of help you through it so you don't have to rebuild it from scratch. But just know that it really is important, and they really are going to analyze that. Many moons ago, I had a potential customer come and apply for a loan to start a body shop. They had a bright and shiny, beautiful business plan, and it looked like they were going to make $1 bazillion in the first year. And we dug into the numbers, and literally, I know a little bit about body shops. You bring in a wrecked car, and they have to tear it apart and fix parts and put new parts on and paint it and all this kind of stuff. Well, their business projections, when we broke it down, they were literally going to complete from start to finish 1 car every 2 hours. Well, probably not feasible. So just know the bank is going to look at it, so make sure that their numbers that are realistic, and also don't sell yourself short and make them underpredict yourself either. So the figure that the banks use to calculate cash flow is debt service coverage. So when you're looking at your financial projections, when you have your financial projections, the banker is going to look at what is your net operating income. So what is your income after all your income and all your expenses, excluding depreciation and interest expense? What is that number divided by the total of the loan payments that you're going to be making to the bank, or any of the debt payments you're applying for? Banks have different numbers that they want that target to be, but basically that number, if it's a 1.0, so if say your net operating income is $100,000 and your loan payments over the whole year are $100,000, that's a break even. You're at 1-to-1. So that means for every dollar of basically profit you have $1 to pay your loans, which means at the end of the day you have nothing left over. So the bank wants that number to not be 1. The bank wants that number to be something larger than 1. It's usually somewhere in the 1.25 to 1.30 times, meaning that for every $1.25 or $1.30 of profit you only have $1 of debt that you have to pay with that. So you have 25 or 30 cents left of every dollar. And the reason is not because the banks are greedy. It's because they want to make sure that you have a little buffer in there, that a break even isn't something you really want to do long term. So the bank wants to make sure, again, you have the cash flow or capacity to repay the loan. The other number is a debt to income ratio. This is more used on the personal side of lending and the mortgage side, but it also does factor in sometimes into small business banking. So that's just, your total of your debt payments, including rent if you rent versus owning your primary residence divided by your total income. And that's usually something the banks like to see under 40% based upon what kind of a loan you're applying for. The next one is collateral. So in conventional banking, these are the two big ones: capacity/cash flow and collateral. Collateral is what you're going to give the bank to secure the funding that you're applying for. This can be all kinds of things in business. It can be real estate, it can be equipment, it can be sometimes it's accounts receivable or inventory in your business. It's basically, if you look at the assets of the business, what's tangible in it that the bank can kind of get their hands on as collateral. To talk about the bad side, what that means is if your loan goes bad and the bank has to collect on it, what would they have as collateral to basically take and sell? So banks look at different collateral differently. So I say that the word advance rate, that's another banking term for you. So that's saying, so if I'm giving real estate, traditionally a bank will loan up to 80% of the value of a piece of real estate that you or your business might own. If a conventional bank is financing something like equipment, it can vary a lot based upon how specialized is the equipment. Is it something that's easily sellable, or is it something that's very specific to your industry, which might be a very limited type of industry? In that case, if it's a kind of a specialized type of equipment, you may be looking, the bank might only want to loan you 50% of what the equipment is. So how much a bank is willing to loan you against the collateral is based largely upon what the collateral is. The collateral that banks like the most is real estate, because that's something hopefully that is increasing in value versus like a piece of say a vehicle, which we all know decline in value unless you're driving some collectible car for your business. So cash flow / capacity and collateral, two of the big ones. The third one's capital. So this is how much cash, capital, equity you have in the project. If it's an existing business, lots of times you can see this from the existing balance sheet, what the owner's equity is on your balance sheet. It can also, for real estate loans, it can also be like the loan to value. So if you're buying a $500,000 or you own a $500,000 piece of real estate, you might only owe $300,000 against it. So some of your capital could be equity in the existing real estate that you have. The next one's character. So this is where in small business loans and most commercial loans, like 99% of commercial and business loans, you're going to have a personal guarantee, which means you may have an LLC set up or corporation set up or partnership set up, and people think, well, LLC means I'm limiting my liability. Well, the bank's going to make you sign a personal guarantee, which means if your LLC or your corporation doesn't pay or goes insolvent, the bank is going to come to you to make the payments or to make the loan whole. So how does the bank kind of determine what your character is? I mean, it kind of seems a little private, but one of the things is your credit report. We're going to pull your credit report. The bank that I work for business loans, we only pull TransUnion for what that matters. But your credit score will kind of show like what's your history of repayment. Have you always paid on time? Have you had some issues in payment? Things like that. It'll also show public records. It'll show like if there's been any bankruptcies or liens or things put against you that way. But another thing is there's also your reputation in the community. Champaign-Urbana seems big sometimes to some people, but it's really not. So if you've kind of done something bad to one bank, the chances are the other bank might probably know. Or if you're, a great upstanding person and probably, chances are, again, we're bankers walking amongst all of you. We're going to have seen your business and have some familiarity with it. And then conditions. So this is one that I've given this presentation probably over the past 10 years. It's not one that the conditions was always kind of like, oh yeah, it's the conditions, the economic conditions of the time, you know. When we were doing lending in the 3s and 4s a couple years ago, it really wasn't something we considered. But now that, you know, we're doing commercial lending in more like 7% interest area, it's a lot different than when we were talking about 3 and 4. So, you know, it literally costs almost double today to borrow money than it did 3-4 years ago, just because interest rates have gone up. So it's obviously it's more expensive for you to borrow money. So that's something it's considered by the bank, because it's, you know, that when we calculate your debt service coverage ratio, that debt payment's higher than it was 3-4 years ago. And this slide everybody's going to glaze over, but so this is also not a secret. Why have rates gone up at banks? I mean, a lot of people. I actually gave a presentation similar to this just about interest rates at a group of very well-known real estate developers here in town who have been borrowing money from banks all over town for years and years and years. And they kind of didn't understand it either. Like, well, why rates are up? Okay, what's that mean? Like, the Fed changed rates, but is that why the rates went up? Not really. When you're borrowing on a commercial loan basis, the U.S. Treasury note is really what's driving your rate. So if you want to know, are rates going up or rates going down, just do a little research on what economists are saying that the 5-year U.S. Treasury yield is going to do, and you'll have a really good idea of what commercial rates are going to do. And the quick and dirty of why is because banks bring in deposits, we hold deposits, and then the way we make money is we turn around and we loan them back out to you. So if we don't have a loan, if you don't want a loan from us, and we don't have anybody else that wants a loan from us, what can we do with it? We can go out and buy a 5-year U.S. Treasury note. And why a 5-year? Well, 5 years in comparison, because typically when you do commercial lending, you're getting a 5-year guaranteed rate. Anything beyond that, the bank's not going to fix it for longer than that. So us going to buy a 5-year Treasury, we can take those deposits and invest them in a 5-year Treasury. We know what our yield's going to be the day we buy it over that 5 years. Just like when we loan it to you, we know what the rate you're going to pay us back at is. However, there's more risk in giving a loan than there is buying a U.S. Treasury, which is backed up by the faith of and strength of the U.S. government. So this is what this is actually through last October, but it's not that much different. I pulled the 5-year Treasury yield today is like 4.4. So it's about half a point less in here. But this is just over the last couple of years. You can see how low it was. It was, you know, it's gone way up. So what that means is the difference in those rates. I think I have the next slide here. This one. So in October of 2020, the 5-year U.S. Treasury yield was 0.332, and now this is 4.9, but it's now like 4.5. So literally, the cost to borrow has gone up over 4%. So that means that the cost to borrow today, for every $100,000 you borrow, is $4,600 more in interest expense that you're just writing a check for. That money is no better. The money you're borrowing today is no better than the money you borrowed 3 years ago. It's just that the rates have gone up that high. And that's the why. Because the U.S. Treasury yield, there's lots of whys why the Treasury yield went up, but that's why the rates are higher now than they were a couple years ago. The other rate that the government directly controls is the prime rate. So this rate, and I have a table here, you can see how from March of 2020 through July, the last time they changed it, of 2023, it went from 3.25 to 8.50. So this rate is the rate that drives a lot of short-term borrowing. So if you get a line of credit from the bank, or any of us who have credit cards, prime is what that rate is based on. So typically in a bank, a secured line of credit for a business would be something like prime plus 1, prime plus 2, prime plus 3, something like that. Whereas, you know, credit cards are like prime plus 20 or prime plus 24 or something like that. So this prime rate is how businesses borrow short term for lines of credit and credit cards and things like that. But you can see how much more expensive it has gotten to be to borrow short term also. And this is the why, because the government has increased, the Fed has increased prime this high. There are talks about them lowering it. I don't think they'll lower it until after the election, but there was talks about that, but probably not. But probably next year, as it looks today, probably prime will come down so that it should get a little cheaper to borrow short term and on a revolving basis next year. So this is the establishing a banking relationship. I kind of touched on this a little bit, but what I would tell you is, so I'm in the business of loaning money, so that's what I do. That's how I pay my bills. But what I'm going to tell you is, maybe don't just go talk to one bank, unless you're talking to me. But maybe talk to a couple banks, because number one, not all banks have the same appetite for credit. So what does that mean? That means some banks may just literally have done a lot of loans in the industry that you're looking to get into or are already in. So say that you are a machine repair shop and you come to me for a loan, and say my bank has done tons of loans to machine repair shops over the last few years. Our bucket in that industry is full. So our appetite for your loan, nothing against your business. You could have strong collateral and strong cash flow and you have great character and all those 5 C's might be hitting. And it could be nothing about you. It could literally just be that my bank has too many loans to your industry. So we really don't have an appetite for it. So it literally could be something where the bank would like kind of turn you down because of no fault of your own. So I would say that's a good reason to talk to more than one bank, because you can go to FDIC.org and look and kind of see where banks have some concentrations, but it's not going to drill down very far. So I would say, talk to a couple bankers, keep us honest, if nothing else. Maybe both bankers want your business really bad, get proposals from both of us and compare and contrast. Go with the person that you feel most comfortable with. The other thing you might look at, especially in today's environment, is what the bank's loan to deposit ratio is. This became a thing probably about a year ago. There was PPP money and a lot of stimulus money that got pumped out to consumers and businesses. That money went into people's checking accounts. So banks were sitting on super high historical balances in deposit accounts. So one of the ratios that, first of all, banks are super highly regulated. That's why the collateral concentration is an issue, because if we have a concentration in one thing, the regulators are going to say and smack our hands and maybe write us up. Same thing with the loan to deposit ratio. So a lot of banks, when they had all those deposits from businesses and people, they went and just loaned it like crazy. We've got all this cash in deposits. Loan it, put it to work. Well, remember, those rates were 3% and 4%. Now that a lot of that money has been spent, businesses and consumers have spent it or done other things with it, and so the deposit balances in the banks have come down to more normalized levels. But a lot of banks did all these loans, so their loan to deposit ratio is gotten out of whack. They basically have in some instances they have more loans on their books than they have deposits, which is a regulatory issue. So if you go to a bank, again, everything's spotless. You've hit bullseye on all 5 C's of credit. The bank might say, we really don't have an appetite for your loan right now, and it has nothing to do with you. It could be because their balance sheet is a little out of whack right now, and they want your deposits. They don't want to give you a loan because they need to get their loan to deposit ratio back into order. So remember that. Another reason you might check it out, you can pretty easily find out what a bank's loan to deposit ratio is on FDIC.gov. Some banks, every banks have different loan policies. So just because they're a bank doesn't mean they have the same policies, doesn't mean they have the same appetite for credit. So another reason to talk to more than one bank, because you might be a great fit at one bank and not the other, just because of the type of policies that they have. Some banks also have lenders that have specializations in certain types of industries. And I think back to a bank I used to work at years ago. There was a guy, his specialty was trucking. I mean, all he did was bank trucking companies. If you're getting into a trucking company, it might be very valuable to you to have a banker who has expertise in the trucking industry, because they can be a great resource for you. And again, I kind of talked about this. Interview bankers when you look to establish relationships with them. It should be a two-way conversation. It shouldn't be them grueling you over your business plan and what you're planning to do. Ask them about the bank. Ask them about some of these things in the table, in the bullets above, and see what they say about those. Remember, your banker is your ally. Again, I know Bankers we have a very bad past in some instances. Don't be intimidated by your banker. If you are, don't use that banker. Find a different banker. Be upfront and honest with your banker. They have to tell your story to somebody else. There's a very rare circumstance where the person you're sitting across the desk from talking to about your loan request is the person who ultimately is going to make all the decisions. Even if your banker can approve that loan, someone else is looking at it after the fact. They need to know your story because they need to sell you and your request internally also. So get them on your side. Make sure they have all the information that they would need to kind of tell your story, because there's going to be people making decisions on your loan behind the scenes that you won't get access to and be able to show your charm and all that good stuff. You need your banker to do it for you. Said like a banker can't likely make the decision on their own. And a really, really, really good team to have are these three: banker or financier, your CPA, and your attorney. The three of those, making sure the three of those people know what's going on, are on the same page, is really a really, really good team. And I always point this out. Of those three, the one that doesn't charge by the hour is the banker. The other two charge you by the hour. So the banker's free, except when you make your loan payment. That's for me. That's it on mine. So if you have questions and answers, hopefully you have questions, please hold it till the end and we'll address them together. Do you want this?
I'll take it, since you have it out. Thank you, Bryce.
Here's your clicker. We got a.
Let's see if I can get this. Yeah. Put this little guy down here.
All right, good evening, everyone. My name is Tristan Brown. I'm the Illinois Operations Manager for Justine Peterson. I'm housed at the Economic Development Corporation here in Champaign County. So Justine Peterson, who are we and what we do? We're a non-depository, so we don't hold deposits. We're a not-for-profit CDFI, Community Development Financial Institution. Now, before I get into the financial part that we all care about as business owners, I just really want to get this out there that we do not compete with banks. And I want you to think of us as more of a graduation program to get you to mainstream or traditional financing. And the whole point of this program is to have that end goal. And our max term is 7 years or 84 months, and then within that 84 months, again, that end goal is to get you to that mainstream financing. So we're a CDFI, Community Development Financial Institution. We've historically worked with those historically underserved or underserviced through one way or another. And we also work with businesses who may not fit the credit box or fit the credit appetite for whoever's in your market at that time. We're also an SBA intermediary microlender. The definition of a microloan is up to $50,000. These can be used for equipment purchase, working capital, inventory, so on and so forth, hires. And we're also a credit building agency and a HUD certified counseling agency. So we do home ownership assistance, coaching, and credit building. And the credit building is actually integrated within our small business program. So if you have personal financial issues, we can address those while going through the program as well. We've been around for 27 years, since 1997. We're traditionally based out of St. Louis, and we're the #1 SBA microlender in Illinois and Missouri. So just a little overview on our work so far. I've been in Champaign County since September of 2022. Since January 1st of 23, we've deployed over $2.5 million in commercial capital to local businesses in Champaign County. We've partnered with the local Black Chamber, SBDC, City of Champaign, City of Urbana, the county, and we also have worked with Business Elevator. And we also have multiple bank investment partners within the area as well, including Busey, PNC, and Woodforest is actually on there too. So where do I start? So I'm going to be talking a little bit about how our process works and what we're looking for. So the #1 end-all be-all is maintain financial history and establish your personal credit. So it all starts off with personal financials. When working with us, since we're an SBA intermediary microlender, you will be signing as a loan guarantor, meaning that this will be going on your personal credit and affecting your debt to income ratio when going through with other loan products. So just to keep that in mind. And we do look at personal credit. And when starting out or when in the early stages of your business, that's usually the case. The lender will always, most likely use your personal credit in decision making. I get this question all the time. How do I establish business credit? Where do I start with that? And that really is one of the last steps you should be looking at when moving forward with operations. Establish an FEIN. Decide if you want to move forward with a sole proprietorship, LLC, or corporation. And again, we're going to talk about those cash flow and projections and what we look at in the process and why it's so important. The business plan, we usually do not provide as heavy of technical assistance for the business plan, and that is why we layer our resources with the local SBDC or the local library services. They're great. And then the last step is to search financial options and resources in your area. Compare local products, like Bryce said. Not all bankers are cut from the same cloth, and they might be looking for something different in that time. So financial history, what we see. So W-2 employment is highly recommended. I get it all the time. Whenever you're wanting to do a startup business, you're looking to quit your daytime job right away, and that is not the way to go. That income is really going to be floating you when starting out. Verifications of cash flow or monthly income. Again, keep track of your pay stubs. Make sure that you're depositing in your personal account. Make sure that you're maintaining personal statements. Make sure that you're filing your taxes. Maintaining a positive personal transaction history, so make sure that your personal financial statements aren't littered with NSFs. Move forward with a competitive credit score, and again, our coaching can help with that. And then cash on hand is always recommended as well, or capital injection when moving forward with a business startup. So some of our loan products, like I said, the definition of microloan up to $50,000, so that's usually what most of our business loans revolve around. We do have a CDFI commercial loan that goes up to $150,000. Now these are for your more established businesses who have those 2 years of operations most likely. But again, don't let anything deter you from moving forward with an application. Like I said, our max term is 84 months or 7 years. And during that time period, we're looking to refinance you with a mainstream lender in your area. We also offer CDFI contractor loans up to $150,000. Now this is a 90-day term with 0% interest. It does have a loan origination cost. And then we also offer the SBA Community Advantage Loan Program, which is similar to the 7A or 504 loan program. Now projections, where are you going? And this will be included in your business plan. And like Bryce said, this is one of the main things lenders look at. This describes your project goals. This describes how you're going to pay us back, how you're going to make your money. Is it feasible? And this usually goes out between 6 months to a year to 5 years sometimes, depending on what your project goals are and what you're looking to do. Whenever it comes to collateral, what we look at, and these are just some of the thresholds, no collateral or unsecured is the term that we use, and these are loans up to $3,000, we can go unsecured. If you have 700 plus credit score, we can go up to $20,000 unsecured. Equipment loans, these are general UCC loans, specifically used for equipment up to $3,000 to $10,000. And whenever you're looking for a vehicle for your small business, that's usually between the $10,000 and $20,000 range. And then anything real estate involved is between $20,000 and $150,000. Now, again, I'm going to throw that caveat in there. We usually do not go past the $50,000 mark, so this is usually not used for rental properties or passive income. And we can also use life insurance policies whenever collateral is really not what, I mean, just to get us over that hump sometimes. And collateral can be purchased with the loan funding. So, for example, truck drivers, I've worked with truck drivers who have added to their fleet. We purchased that collateral, the truck was used as collateral. Same way with homes, so on and so forth, equipment. Now, here are the expectations in the JP process. Day one, in-person one-on-one meeting with me. Like I said, I'm located here in Champaign County. And we discuss project goals and taking required documentation. The required documentation that we like to see is at least 3 months, the last 3 months of clean bank statements, no NSFs, for your personal statements, the last 2 years of tax returns for your personal tax returns, and pay stubs and driver's license. That's really the, and of course we take a look at credit, but that's really not the end all be all with us. Our approval is actually based off of a matrix system. So let's say if you don't have good credit and you have good bank statements, you may still be able to qualify. Day 7, we have a follow-up meeting for any other discussions, questions, document intake that you may need. Day 14, on all of our low dollar loans, which is $20K and below, we're expected to be closing by day 14. And then anything above that usually requires, again, that due diligence time period between day 31 and the day 90 period. So we're ordering appraisals on the collateral, scheduling title companies, so on and so forth. So all of these services are actually available in Champaign County currently. And we also have our credit building loan products are up to $3,000, and these can be used for personal issues as well. I'm a full-time staff person housed at the Economic Development Center and the Small Business Development Center. And I think it's time for questions.
Okay, what are SNFs? You said SNFs, you like to see clear.
Oh, NSFs, yeah, okay.
You can
so,
take that
sorry. Yeah, non-sufficient funds, I'm sorry. So negatives in your bank statements.
Oh, okay.
Yep.
That makes sense.
Yep.
We love acronyms.
Yeah, I'm sorry for throwing so many acronyms, and I felt like I've kind of
The
talked.
same loan. You don't have to have a 5-year fixed rate. You know, if you truly think you can pay the loan off in faster than 5 years, you can apply for a 3-year loan, get a 3-year rate, and that way you won't have, you know, that prepayment penalty spread out for 5 years.
Keep that in your terms. Prepayment penalty.
Ask that question when you do your interviews. And ask them to define what the prepayment penalty is. Because some banks will just say, it doesn't matter why we get paid off. You could have, the building could burn down and you get insurance proceeds that pay us off, we're still gonna get a prepayment penalty. That is not how the bank I work for defines our prepayment penalty, but it's a question you should ask the bankers that you talk to.
Normal banks, when you take a loan, you pay off the interest first before you start getting into the principal anyway, right?
Well,
So,
you wanna take amortization?
yeah, so that's monthly interest. So I mean, if you get a 5-year loan and your finance charge is $20,000 and you pay it off early, that finance charge actually goes down. So you look at those loan documents and it says if this loan goes 5 years, you're paying back $20,000, but you pay it back in year 2, then you would have to do the calculation on how much of interest you've paid up to that point, or ask your lender. But so to answer your question, no, you actually don't pay all of your interest off first when paying off a loan, but whenever you're making monthly payments.
You stretch it out.
It's loaded heavy towards interest in the beginning of the
Exactly.
loan, and it starts to go down. So actually, bankrate.com is a really good website to run an amortization. And you can click more detail, and it'll literally show you the whole life of your loan every month, how much is going to principal and interest. I actually use it all the time. Another bank's website.
And
but-
here's another term for you is amortization schedule, and that is a full list of your payments that you make throughout the term of the loan.
The 5% repayment fee, that's 5% of like your remaining
Yes. And then,
So it's still less expensive than like following out the.
yes, yeah, it would be, yeah. Yeah, and then the next year it's 4%, and the next year it's 3%. So the longer you go, the lesser it becomes a burden.
Just letting everyone know, this is not my phone number anymore, too. I've got cards in the back. Sorry.
Whose number is it?
It's my assistant now. Sorry. He'll still get you, Tim.
Yeah, yeah.
Okay, so then you said that the best collateral is real estate, but my question is what's the difference when you're looking at a business loan and someone has a house, so you can see they have collateral versus suggesting that they get a second mortgage or use their home equity?
That would be something I would hope your banker would talk to you about, because I mean, there's lots of ways to do it. I mean, if you're applying for a loan and you have equity in the house and you're the owner of the business and you own the house, I mean, you can do the loan and literally you can pledge the house, mortgage on the house as part of the equity for the loan. Sometimes people, go get home equity loans on their house and use that for their business purposes. Just know though, if you come to a bank and apply for like a home equity line, and the purpose is a business, we cannot do a consumer home equity line for you if the purpose of the loan is business related. We have to do it as a business loan. But lots of people have home equity lines that have been in place. We do them, and they're 10-year lines. They're there, and we don't. If you have one and you access, we don't ask you every time you access the line, what are you going to do with the money? It's yours to access and use what you want. So a lot of people starting out small businesses, that line between personal and business blurs a lot. You'll see, and I warn people, but if it's truly short term and you truly are going to pay it off, it can be effective to like 30 days to use a credit card for something if you're going to pay it off. But if you're not, you don't want that high interest to eat you up. So think about that and be diligent in what you do with it. But to his point earlier, if you are kind of commingling, I know a small business and you are so closely intertwined, but have a separate account, keep everything separate, keep a set of books for the business, even if you are using like equity in your home from a home equity line on a personal loan, like make sure you're accounting for it. Because number one, your accounting bill will be cheaper at the end of the year when your CPA does your taxes. And secondly, it's just the right thing to do. And it's for you to run your business and be able to see, here's my business and here's my personal, and they're separate.
Yeah, I mean, in my case, like I went for a business loan, but it was almost 40K, and then they kept being like, well, we'll just use your home, we'll just do the home, and I, again, wanted to keep it separate, so that threw me off, like, well, why can't I just get a business loan? And then it turned into this whole, well, we really only work with businesses that do $5 million
Yeah.
a year. So it's this back and forth, like trying to figure out, I guess, all the ways that you can borrow money.
Yeah. And if there is equity in the home, that's going to be the bank's preference, and that they should make it your preference too. The loan should be more attractive to you if you're using equity in your primary residence versus if you're using something else. And there's a way to properly do it. I mean, I'm not an accountant. Talk to your accountant, but if you're using that equity in your home as a you on the books, maybe do it as a loan. Loan from shareholder kind of a thing, and that's where you're keeping track of. You're kind of taking money out of the equity of your home, you're loaning it to your business, and keeping track of it that way. But I'm not an accountant, so consult your accountant on that.
There are tax incentives, though. So, I mean, that's the whole point.
Yeah.
So.
Any other questions?
I just want to know when I can be able to call you and maybe come here. I want the person to come up and meet you when,
Him?
he sounds more attractive.
See? I like it.
So
That's not an
actually,
insult.
On all of
No,
my
not at all.
on all of my business cards in the back too, there's a QR code.
I got you.
Yeah, perfect. You can scan that QR code with your camera, and it brings you to my Calendly, and you can just schedule yourself from there, and it tells you the documentation to bring, what to expect, all that good stuff. But I still want to meet you, sir. Tristan Brown, nice to meet you.
I did want to make one more plug. I mean, Justin Peterson, great.
Nice to meet you.
You too. lots of great local banks in town, but also don't forget we have other programs like the CDC. Kathy Larson at the CDC is amazing. Don't forget those loan products there. Check into those. If you're in Champaign County, I think all of her programs apply. So there's lots of resources out there. Lauren can direct you in the right way.
All right, well, thank you so much.
Thanks for having us.
Informative.